Hey everyone, welcome to another week here in Georgia Real Estate. I'm Sarah Maslowski with Moving to Georgia, and I have a really good treat for y'all tonight. I don't know if you've seen the headlines that have hit the news feeds and coming up in news articles and stuff like that, but there's been a lot of talk of whether or not if you have good credit, if that's actually hurting you in the future due to a new rule that's set to go in effect May the 1st. So welcome to the live stream. John Burchfield with Capital City Home Loans. If you are watching the live stream again, you may have seen John before here on the live stream, but welcome, John.
Hey, thanks for having me. It's great to be here.
Yeah, awesome. So if you are a client of ours, you likely already know John. He is one of our really great preferred lenders, and you may have already connected with him. And we are talking about headline that has hit and kind of come across our desk, and we've had conversations about this. But that's the fact of if you have good credit, are you going to be paying higher lending fees, or is that going to impact your mortgage payments? So where has this come from? Like, why are we all of a sudden talking?
Yeah. So what this is referring to is Fannie Mae and Freddie Mac, those government institutions that provide the funding and the liquidity to like about 70 to 75% of all mortgages done in the country, have changed the way they create pricing models to associate to different risk levels associated with funding a mortgage. And that flows all the way down the channel to impact a borrower's or buyer's bottom line as to how much they're going to have to pay for a mortgage. So they changed that recently, and they did so kind of moving away a little bit from a risk-based model, meaning the riskier the loan, or at least the perception of risk, the more a buyer would pay, and move to a more what they're referring to as an equitable model, so that folks that might be first-time home buyers or have had some struggles in the past, that they not be priced out of the ability to get a mortgage. And they had to get the money from somewhere. So they made the benefit of having really good credit or putting a lot of money down just not quite as good a benefit as it used to be. It doesn't cost more. Okay, go ahead.
Yeah. So the big question that everyone has, and I've gotten several phone calls from clients that we're working with, is that are they getting punished, or are they paying more than what someone with bad credit is paying?
No. If you have a credit score in the lower 600s, you are going to pay more for your mortgage than somebody that's got a credit score in the high 700s. Okay, that is not going away. That is still there. It's just that it's a little bit more affordable for the low 600s. And the benefit that you did get for having a really high credit score isn't quite as large of a benefit as it used to be. So they squeezed the two together a little bit, is the way I kind of think of it. Yeah, the lower credit score borrower is still paying more, but the difference between the two is not as great as it once was.
Yeah. So I have a really good article that kind of dives into this a little bit more. And so we're going to kind of go through this. And I think this article hits it spot on. And you and I both agree. It says, seemingly overnight, the internet is awash with news regarding a new unfair tax on mortgage borrowers with higher credit scores. And so actually, this information came out in January. So they introduced, or they said that, hey, they announced it in January, this is going to come out in May, or go into effect May the 1st. And so the question here it's kind of posing, so low credit borrowers are already getting a discount, why high credit borrowers are paying more? And it's saying not exactly.
Right.
And this article kind of goes on to say that this isn't like really take an opinion. It's just kind of stating, here are the facts for you to make your own opinion.
Yeah.
So there are some really good charts that, before we get to the charts, basically what it's saying is that a low credit borrower isn't paying less than a high credit borrower. It's just the gap between what they pay is smaller than what it was. And so the way I understand it, John, is that a low credit borrower used to be kind of like really punished for that low credit. Yes. And so the gap in between the rates and the fees that you could offer someone with good credit versus bad credit was pretty darn wide, right?
That's true. And to take that a point further, someone that is trying to buy their first home may have had a ding or two on their credit. They often are not going to have the capacity to pay those high fees to even secure that mortgage. So this structure is intended to make that home more affordable. That's the focus for that lower credit score borrower and bring them into the home buying process.
Got it. So the fees that they're charging, it seems like, and also if I'm understanding this correctly, that that the low credit borrowers are just not getting punished as much as what they were. They're trying to make it a little bit more accessible for someone with a low credit to not have to pay kind of like as much of a penalty and punish them even further to prevent them from buying a house.
Yeah, exactly.
Is that correct?
They're still paying more, but they're
Right.
paying not as much as they were a few months ago.
Got it. And I think this is zooming in on the screen for y'all at home. Perhaps let me check on that. Yeah. Okay. And so here is a chart that kind of sums it up. And this is the purchase loans change versus the previous. And it kind of goes into how much it's changing. And so you kind of see that if you have a low credit score, it's actually improving. Those fees are improving a little bit. And then it's also like if you have a high credit score, though, you're now paying you're not getting as much of a discount as what you used to get. Is that correct?
That is correct, but let me add a caveat to that, which is not being talked about at all. Do you see that on the FICO side over here, which is credit score on the far left? Do you see how it's broken down into those different tiers of
Yes.
basically every 19 or 20 points? You get a different price associated with that block of credit scores. Well, the old matrix ended at 739. So a 740 credit score got the exact same interest rate as somebody with an 805 credit score.
Okay.
So now they have went ahead and said, hey, let's continue to break that down even further so that a really, really, really high credit score, 780 plus, is going to get a benefit that did not exist previously. It was the same as it was. So in that high tier, there's been positive movements, meaning that the mortgage for a really high credit score borrower is going to be less expensive now than it was a few months ago.
Yeah. And so if you're just now joining us on the live stream, I have my trusted lender on here, John Burchfield with Capital City Home Loans. And we are diving in and talking about the recently announced kind of news, even though it's not so recent, that's hitting May 1st. Kind of some changes in how they're charging borrowers depending upon their credit score. And of course, if you have any questions at all about buying a house, selling a house, or obtaining a mortgage that you want us to answer, go ahead and drop those into the chat. We're going to get to those in just a second. So, John, a question that has kind of come up in this article addresses it as well, is that, if should you just not care about your credit score anymore? If you're getting punished for having a high credit score and someone with a lower credit score is kind of getting a little bit more of a benefit, should you just not care about your credit score if it's not going to matter to buying a house? And what would you say to that?
No, that's nonsense. You're still getting a cheaper mortgage if your credit is good, right? That's not changing. That's not going away. But there's two other things that really isn't mentioned here that we should be. Remember me saying that this is referring to Fannie Mae and Freddie Mac, those government secured entities that provide about 70 to 75% of the mortgage market. Well,
Right.
The other 20%, and there's some others thrown in there, but there's 20% that's provided by FHA. These lower credit score buyers who don't have a lot of funds to put down, they're going to go with an FHA type loan anyway, to the point that, you can look at this chart and we could take, for example, if a buyer only had 3 or 5% to put down and they had a 660 credit score, well, they made that loan more affordable. But guess what? They can't get approved. They're just not going to get approved, right? We're going to take that same borrower, FHA, they're going to get a better interest rate than anything we're talking about here, because FHA is specifically designed for, I've had a ding on my credit and I'm not putting a lot of money down. And they're not even going to be a factor in here. So a lot of this is a lot of talk about nothing, right? And that's why it still pays to get a great credit score so you can fit into this type of mortgage in the first place, if that makes sense, so you can get approved.
Yeah. So one of the questions I had for you was, okay, this new rule is going to go into effect May 1st. If I have clients that have been pre-approved, do I need to go back and have conversations with them or put them back in front of you to say, hey, here's what your new payment is going to be, and kind of explain that to me or us?
Yeah. So the first is that you're right. These are for loans that are delivered to the secondary market after May 1st. So we had to put these adjustments in place weeks ago. So we've already, any rates that we've quoted for probably the last 6 weeks has already taken this into consideration. Number one. Number two, the normal everyday ebbs and flows of the market account for way bigger adjustments than what you see here. This is a great talking point, but in the whole scheme of things, the pricing of a mortgage can move a quarter point within a few hours on the open market. So I could quote a deal at 10 o'clock in the morning and it'd be different at 2 p.m. by more than anything we're seeing on this chart.
Got it. So that's a good mortgage question that comes up. With as much volatility that we've seen in the market and interest rates going up and down, how do you know as a buyer when is a good time to lock in your interest rate, and what does locking in your interest rate mean?
Good question. So locking in your interest rates means is you pull that money out of the market, the money that you need to borrow, and you say, I now commit to pay this price, meaning discount points and interest rate on this loan amount, this block of money, meaning your interest rate is no longer subject to the ebbs and flows of the market. Generally speaking, if somebody's within 30 days of closing, we want to seriously look at locking in. Because what we kind of know, we don't know our interest rates getting better or worse or by how much in either direction. But what we do kind of know is that when interest rates improve, they kind of improve slowly. It's just a slow tick downward. If any news were to hit the market to move the markets upward, where interest pricing is getting worse, that can happen very, very quickly.
Yeah.
So once you get within 30 days, we generally talk about, hey, let's get this locked in, because the risk versus possible reward is, it's better just to know what you got. Bird in the hand versus two in the bush kind of scenario. Now, if you're outside of 30 days, we're going to talk more. And this is primarily because the longer you have to lock in that interest rate, the higher price you're going to pay. A 45-day locked mortgage is slightly more expensive than a 30. A 60 is slightly more expensive than 45. Once you get beyond 60, it becomes significantly more expensive in the volatile market that we're in now. So we have to take that into consideration.
And this is also why whenever you're getting pre-approved for a new home construction that's still in the process of being built, it's really important to kind of know that if the home's not going to be finished for another 3 or 4 months, whatever interest rate you're quoted today is not likely going to be the same interest rate. It could be higher or it could be lower, and who knows right now with the market that's going on.
Could be. And on new constructions, there's always options to lock in really long-term, 6 months or more, but you pay a significant cost for that. Expect a higher interest rate, and you're likely going to have to pay some upfront non-refundable fees to secure that interest rate lock.
Yeah. So, thank you for answering that. And for those of you that are joining us, we are answering your questions about the housing market, lending, purchasing a house, what that looks like, and answering your questions. So we have a viewer, El Jefe, says, it seems like unless I put down 20% with high interest rates, I can't afford to buy a house, even with an 800 credit score. So,
well, I hate that there's that general thinking in the marketplace, and I can understand where it comes from. But here's what I often challenge buyers to think about is that if interest rates get better, then that means the price that they pay for a home is going to be more expensive than what it is today. That's just the general way the market works. And the best case scenario for buyers, in my view, is to secure the home, get the mortgage done, and if rates get better, then you can refinance to get that lower payment. Okay. Now, what El Jefe may be talking about is, should the J be silent? El Jefe may be talking about is that, when you don't put 20% down, you have to pay mortgage insurance. And mortgage insurance is an added cost to your monthly payment that you have to consider. But there are creative ways to mitigate the impact of mortgage insurance. You can pay a one-time fee to make it go away. You can split it up where I pay a little bit up front, but I pay a little bit monthly. So working with a knowledgeable, experienced loan officer that really knows how to see what the payment goals are and then try to create a game plan and a path towards meeting those goals could often mean getting into a home without having to save up 20% down, because that's a big task. That's a lot of money.
Yeah, it's a significant amount of money. And I would also kind of encourage you to maybe think outside the box of where you've currently been looking. If you can't find an affordable area of where you want to be, likely there's going to be other areas that maybe it might not be ideal, but it's a way to get into a house, pay yourself, pay your own mortgage, and get into something that you can afford that meets those goals. I love that you said of being able to pay that PMI as a one-time fee up front. That was something that you taught me that I didn't know about. And I regularly talk about this with clients all the time. And it's something that a lot of people don't know that you can do. So you can still get rid of the PMI and put down less than 20% by paying that one-time fee. Or like you just said, you can even kind of split it up if, to make those payments more affordable.
Yeah.
Bridge asks, does a 780 credit score is better off putting 5 or 10% down or 20% down based on the new adjustment? And how close are Credit Karma apps score to credit scores that mortgage lenders use? Yeah, so two-part question there. Yeah.
Two-part question.
So let's talk about a 780 plus credit score. Based upon the new rules that are coming out, putting down 5, 10, or 20%, I guess, like if you had the option of what to do, and if you were only, I guess, maybe taking those fees into account, what would that look like? What do you think?
So there's no difference between 10 or 5 or 10% down. You'll get the exact same deal, right? Here's a trick of the trade, and I hope my competitors aren't listening. At an 85% loan with a high credit score borrower, you get better interest rate price than if you put 20% down. Okay, so 15% down is better than 20% down.
And that seems so counterintuitive.
It does, but it's because mortgage insurance becomes a factor. Okay, so the market recognizes, again, going back to that risk-based pricing analysis, that a loan with mortgage insurance is less risky to the end investor than a loan without mortgage insurance. Because mortgage insurance, for example, if you were to put 15% down, the mortgage insurance jumps in and insures for the lender 12% of that loan, which means that the lender is actually only exposed to 73%. So the lender on an 85% loan is exposed or at risk for 73% of the loan that they made. Whereas if we made an 80% loan with no mortgage insurance, we're exposed to 80%. So it's a 7% difference. Right. And because of that 7% difference in exposure, we're able to offer a slightly better price to someone only putting 15% down.
Got it. Yeah. All right. So whenever someone is looking at their credit score and they're trying to make a determination of how good or bad their credit score is, and they're using tools like Credit Karma, how accurate is that compared to an actual hard credit pool that you do whenever you're looking at a loan application?
Yeah. So if you've got great credit with no dings, managing credit very, very well, low balances, it's going to be very accurate, probably within a few points. Okay. But if you've had a late payment in the past, maybe a bankruptcy years ago, or maybe you've got a couple credit cards that are close to being maxed out, it's nowhere close to accurate. I mean, nowhere close. We see them 100 points off consistently. And the deal is that they don't use the same models to really get an actual credit score. They're basically just guessing at it, and that's why they can just be so off when they try to guess.
So is there a good credit tool, or if someone wanted to know what their credit score is that's more in line with what lenders see, is there something that you recommend that they check or do?
Go directly to the agencies and pay for it. So you can go to Equifax.com, Experian.com, TransUnion.com, and you can order a real credit report directly from the bureau instead of going through your credit card company or going through, all the various free online resources, and you'll get the closest to accurate. It's still not a full mortgage tri-merged report. We get a little bit more detail with ours, but it gets you very, very close.
And I think the government now requires that you're able to get one free one a year directly from those credit bureaus. So make sure you're not like on a scam website before you do that. But there definitely is a free resource out there for you.
Mm-hmm.
All right, let's see here. We had another question. Let's see. Anthony asked, for high credit borrowers, are there alternatives to avoid these additional fees? Would it work to put less than 20% down, and then after the loan goes through, put the rest down and recast the loan?
Okay, there's a lot in that question. So the first thing to know is that, referencing back to the first half of our conversation, that they're not additional fees. These fees have always been there, and the borrower never really sees them. They're baked in to the end mortgage that the consumer gets as the lender, us, provides the loan quote to the borrower. Okay. So think of it like this. I'm a baker and I'm selling a cake. Okay. Well, I had to go buy my flour, right? We're buying the money from Fannie Mae and Freddie Mac, and they charge us, and then we're delivering you a cake. So you may not notice that the actual cost of the cake included a little bit of adjustment that, the flour cost less, but the sugar cost a little more. Okay. You still got the cake at the same price. So don't think of it as additional fees. The second part of the equation, in terms of how much you put down, it's all about trade-off. We want to talk about your goals for your monthly payment. And if we can hit that monthly payment with you hanging on to some capital, then that's great. Let's talk about doing that. But if we need to invest more to drive down the loan amount and therefore drive down, pushing that payment into your goal window, then we'll talk about that too.
Yeah.
So recasting the loan, that's a challenge. You'll never see a situation where a lender will guarantee your loan to be recast. Okay. Mm-hmm. For example, if you're missing payments on a regular basis, but then you win the lottery, they're not going to just lower your payments because they're in a hurry to get their money back. All right. So recasting can be complicated. I try to avoid counting on a recast type situation. It's not generally not something we want to move towards.
So one of the signs, in my opinion, of a really great lender is someone that's going to take someone's application, figure out what they're qualified for, but then have like a really detailed conversation of what are your goals? What do you want your payment to be? What is a comfortable number for you and your family? And then look at various different ways to achieve that, or to say, here's one option of how we could do it, but here's another option of how we could do it. And that's one of the reasons that I love working with you is kind of walking people through those different scenarios and seeing and weighing what the pros and cons are of each of those different situations, and then letting the buyer make that choice as what's best for their family.
Yeah, and that's the fun part. That's the fun part. Anybody can give somebody a mortgage, but we want to explore and make sure that they get the right mortgage for them. I'll add another note to that. We need to discuss: are you currently contributing to your tax deferred retirement plans? Right, especially if your employers is jumping in and matching some of those contributions. Well, we don't need to get into a 15-year mortgage and pay a mortgage down quickly if we haven't taken advantage of those opportunities to save long-term money. So those are all things that are going to be on the table, so we get the right fit for the right buyer.
Yeah. Freddie asked, should I not buy down points now because interest rates are expected to come down quite a bit in 6 months and also in a year? That's a magic question.
It is. It is. So the way the market is now is we have what we're referring to as a very flat yield curve. So you can pay one discount point, and let's use some rough examples here, and maybe buy down your interest rate to say 6.25%. Whereas if you just came and said, I want to pay no points, I am not paying points, you'd probably have to go all the way up to close to 7% in that example. So you can see that the power or benefit of paying that one discount point is just a ton right now. So almost everybody's paying at least one. But to Freddie's point, when we start thinking about paying more, somebody says, man, I want that 5.5% interest rate. Well, great, you can get it. That's probably going to cost you 3.5 discount points. But I would have that conversation. Are you going to be beating yourself up if I can refinance you a year from now and get you 5%? Mm-hmm. You should have taken the 6.25, saved your money. We restructured your financing anyway, and you didn't have to invest those 2-3 extra points in the process.
And because there's points for every point, roughly it's about 1% of the loan. So on a $400,000 house, 1 point is going to cost you $4,000. So to buy 3 discount points, that's $12,000. And so there's a lot of kind of like math and pros and cons and weighing of, is it truly worth it to spend that upfront money when maybe, to Freddie's point, in another year, you're going to be able to pay a much smaller fee to do a refinance and get a lower interest rate.
Yeah, exactly. And so we're going to talk about it and run scenarios, put it in black and white. See, this is how your money can work for you, because there's usually a sweet spot, right? Sometimes it's 3/4 of a point. Sometimes it's 1.25 point. But we're looking for that sweet spot on what we call the rate stack. If I'm looking at a 5.5 up to 7%, every 1/8 of a point, there's a different interest rate and a different corresponding price. And I'm looking for where I can get the most bang for your buck. What's the lowest I can get the interest rate for the least amount of discount points invested up front?
Yeah. So we are answering your questions about the mortgage process, about buying a house, selling a house, or the market. So if you have any questions and you're joining us on the live stream, make sure you drop those in the chat below and we'll make sure that we answer those. In the meantime, we often get asked a lot of questions about mortgages and have conversations day in and day out with a lot of people. And so there's a lot of myths around getting a mortgage. Mm-hmm. And so we're going to talk about some common mortgage lending myths. And the first one, we've already kind of talked about this, is that sometimes I hear from people thinking that they need to put down 20% on a house.
Yeah.
Tell me more about that.
No way.
If everyone had to put down 20% on a home, the rate
nobody would have a home.
Nobody would have a home.
Yeah, it would be a lot lower than it is for sure. Here's the quick, simple thing to know is that you can get into a home. There are programs with no money down that we can explore. There are programs where you get down payment assistance grants to come in and help with your down payment. If neither of those ended up being a situation that worked for a particular borrower, 3 or 3.5% down is a common strategy to buy your first home. So no, you don't have to have 20% to put down. And you would be, I often run numbers for buyers who have maybe 20% down, but again, that would be bleeding their savings, wiping them out, maybe liquidating an old 401k that they'd be taxed on, all of those things. So when I show them, okay, well, was your plan to put 20% down, but what if we just look at 5%? And they're often amazed at how little difference it made in the overall bottom line payment relative to how big of a huge chunk of money difference it was to actually save up or come to the closing table with.
Yeah. Good one. Number 2 myth, pre-qualification is the same as pre-approval.
Yeah, this is a pet peeve of mine for sure. The standard definition of a pre-qualification is just when you have somebody pull your credit and they say, hey, your credit's good enough to get a mortgage, you're good to go. A lot of the .coms do this, right? Or the too big to fail banks. They're just pulling a credit report and saying, okay, you should be fine. That's not good enough, right? And it's not good enough for the process, and it's certainly not good enough for the borrower. You need more facts to be able to make an educated and wise decision for yourself and your family. That requires taking an extra step where your lender verifies and approves all of your supporting financial documentation. whether that's pay stubs, W-2s, bank statements, tax returns if you're self-employed. All those things can play an enormous role in how your loan is structured, what your buying power might be, and make sure you get the right fit for you, because there's nothing worse. And I see these heartaches all the time, and I know you do, where you fall in love with a home and then you find out, okay, I didn't know the payment was going to be that much. I don't really qualify for that, even though my lender told me I did. There's a million examples of that, and we never want to put somebody in that situation. So work with a lender that's getting you pre-approved, which means they collected my supporting financial documents, they reviewed it, and they approved it. Okay.
Yeah. And I think this is something that's important also, that if you're working with a real estate agent and they're not asking you for a pre-approval letter, and they're just maybe taking that pre-qualification that you've gotten from Rocket Mortgage or some other online lender, and they're saying, okay, great, let's go look at houses. They're also not putting you in the best financial interest, or your financial interest at heart, because they're essentially setting you up for a lot of failures and a lot of roadblocks and headaches because you haven't gone through that full process yet. So sometimes it may feel like a little bit of resistance if you have an agent saying, hey, let's put the brakes on this a little bit and let's connect you with a really great lender and get that pre-approval process. But it's really for your best interest to make sure that when you do fall in love with the home, you can actually move forward and buy it, and you have a great idea of what that monthly payment is going to be.
Yeah. Ounce of prevention, ounce of prevention's worth a pound of cure. That's kind of what this is. Just take the extra steps up front and make sure it's done right.
Yeah. In the meantime, we got another question from Bridge. When discount points expire and does the rate go up or down? Can we put lump sum amount to keep the same payment? So I think maybe Bridge is talking about like a 2-1 buy down, where it's a temporary rate buy down versus a permanent rate buy down. So that's a good question for us to kind of talk about what the differences of those are.
Yeah, great question. When you think discount points, the idea is that you're permanently buying down the interest rate so that it never changes. Okay, so you'll know exactly what to expect for the full term of the loan. Now, there's also something that's become popular out there called a 2-1 buy down. There's even a 3-2-1 buy down, where you simply take the cost of the difference in monthly payments over that buy down term, right? So let's quick examples. If your interest rate's 7%, you'll get an effective interest rate of 5% for the first 12 months, 6% for the second 12 months, and then it goes to 7% for the remaining term of the loan. Well, the difference in payment over those first 2 years, you literally calculate it out to the dollars and cents of that, and then you charge it as a discount point so that you're paying to subsidize your own monthly payment for the first couple of years. Okay. You still have a 7% loan. You still paid 7% interest for the entire term of the loan. You just paid some of it up front to make it feel better. The goal here, and the reason this is popular, is because one, oftentimes you can get the seller or the builder to pay those temporary buy down fees for you. Two, the thought process is, well, if I pay 5% now and maybe it goes to 6%, but certainly before it ever hits 7%, I will have refinanced to a better loan. And certainly there's a good possibility of that. And then you would have never felt the effects of that 7%.
Yeah, definitely. So if you're watching and you have any questions about buying a house or making a move, or any questions for John when it comes to the lending side, now's your opportunity to ask those questions down in the chat so that we can get those answered for you. So going back to mortgage myths, and this is maybe a good one when it comes to kind of like permanent interest rates and how that affects. Some people believe that if I'm locking into a 30-year loan, that I'm stuck with it for 30 years and I can't pay it off early. Or, hey, we're about to retire and we're about to get some money from this, and we don't really need a 30-year mortgage. Let's do a 5-year mortgage. Talk to me a little bit about paying off your mortgage early and what that looks like.
Yeah, we talk about that a lot, especially with folks my age, where they don't want a mortgage for the next 30 years. So we may end up doing a 30-year loan for them just in case life throws them a curveball. Right. But if they have a goal and the means and capacity to, say, pay the loan off in 10 years, then we can run some simple math to say, okay, well, your payment may be $2,000, but why don't you pay $3,500? And if they pay $3,500, they pay the loan off in 10 years instead of 30 years. And they can just set up their online banking to pay that early, because mortgages typically speaking, certainly every mortgage I provide does not have a prepayment penalty. So you can pay as much towards the principal as you like at any time. Common strategy that, go ahead.
Well, I was going to say, what about maybe somebody who, let's say they have another house to sell and they're going to sell that at some point in the future within the next, 3 to 6 months, but they have the ability to go ahead and buy a house now, but they, and their goal is to use the proceeds from the sale of the other house to pay off this house. I encounter this situation all the time.
All the time.
Yeah. And so some people think that, they can't do a 30-year mortgage.
No, absolutely.
And then so my conversation to them is, hey, let's go ahead and do a 30-year mortgage and you can just pay this thing off in 6 months whenever you sell that other house.
Happens all the time.
Yeah. All right. And our last mortgage myth is that, and this one comes up a lot, applying for a mortgage will hurt your credit score.
Yeah. Okay. So what they're talking about here is a credit inquiry. When someone pulls your credit, it becomes a factor within the overall model that determines someone's credit score. Okay. So two-part question, or two-part answer rather. Credit inquiries are part of the model, but if you've got great credit and you kind of know it, I paid my bills on time, everything's good, then the impact of that credit inquiry, you'll probably never even notice it. It probably won't even lower it a full point. Okay. Secondly, even if it does lower it a little bit, it's likely not to be to the level that it's going to affect anything. It is the least qualifying factor that determines your credit score. So, jumping into a Macy's and buying a couple of outfits on a credit card is likely going to hurt your credit score worse than having somebody pull your credit. If that puts it in perspective, it's not, we really as a group just put this big emphasis on credit inquiries, and yes, pay attention to it, but it's not something that should stop you from getting the facts about where you stand if buying a home is a goal.
Yeah. One of the questions that I often get or have conversations with clients on is they'll say, well, I've been pre-approved with Rocket Mortgage. And then of course I launch into, okay, we really need to get you, connected with a really great local lender. You're not going to have a good experience and I can likely save you a lot of money. Let me connect you with John. And then, the first kind of pushback I get on that was like, well, I don't want to pull my credit again, or that's going to hurt my credit. So my understanding is that whenever you are applying for a home loan, that it's not necessarily going to affect your credit when you're getting multiple credit inquiry pulls when it's related to the same thing. But that it's different if you were getting a quote for a car loan, a house loan,
Absolutely.
Getting a credit card all at the same time. That's where you have the big impact. Is that right?
That's right. Yeah, it's right on, especially within a limited amount of time. So the credit scoring models are smart enough to not penalize a customer for being able to shop around to make sure that they get the right deal for them. So you can have 2 mortgage credit pulls within, I think it's like 25 days. It's kind of an odd number and it's moved up and down a little bit, but it's around 25 days. You can pull your credit multiple times with multiple lenders, and it acts as one hard credit inquiry when it comes to the credit scoring models. So you're not going to see that credit keeps getting dinged every time that we pull it. And caveat to that, if anybody's working with another lender and they want to have a conversation with me without pulling the credit report, let's do that. Let's have a conversation. Let's talk about where you are, where you want to be, what you've been offered, so that we can kind of compare and contrast. Eventually we'll have to get to a credit pull, but we don't have to day one, right? Let's start talking and see where it goes from there.
And one of my favorite things that you do is, if someone's already been quoted a rate, is to get that loan estimate or to get that fee worksheet from the other lender and kind of compare apples to apples and kind of see and look, because sometimes what may appear to be a really great rate, they might be charging a ton in fees to get that rate. And that may not really have been explained, or, you may be able to get a similar rate without as many fees.
Yeah. Our industry still has some bad apples, and every lender has different profit models that they have to hit, so they have different structures, and it can often be surprising how expensive some of the big banks and the .coms, and you just have this perception that, well, I get everything cheaper on Amazon. It's got to be less expensive.
Right.
But the reality is that they have to pay an enormous cost to acquire that customer via all the online advertising, their $4 million Super Bowl ads. And not only do you lose that personal connection by having a private banker that's working for you, but you pay that cost. And I'm shocked often at how many fees are just kind of thrown in there that really shouldn't be there.
Yeah, for sure. So it never hurts to have another pair of eyes on that. I say this all the time, but one of the reasons that I love working with you is that there's been many times where we've had clients that have either had another rate quote or they are buying a new construction home and they've had a really good quote from a lender, and you've looked at that and you're like, hey, this is a really good deal. And the buyer is going off another lender.
Yeah.
And so, we always want to try to keep that in-house as much as possible. But at the end of the day, we want what's best for the clients that we're working with and that we're serving. And that if that's what's best for them, then that's what's best. And you have no problem with telling people that.
Absolutely. Yeah. It all comes around, and we're busy, so we're going to keep helping folks. And if it's better, it's better, so we'll be sure to tell them.
Yeah. This is a good one. And this is, should be this should have been on our myths. Will the 40-year mortgage become the new 30-year in the future because of unaffordability? So have you heard about that, about the 40-year mortgage that was making headlines?
Yeah, I think so. But it'll take a while. I don't think this is anything within the next year or probably even 5 years. And that's unfortunate.
Let me interrupt, because it was my understanding that the 40-year mortgage is something that only they were offering people that were behind on their mortgage as an attempt to get them ahead. And so it's not something that's open to the general public. Like, you have to be in default or at risk of default on your loans. Is that right?
Yeah, a modification. Okay. You're speaking about the current servicer being able to modify that mortgage out to a 40-year because they're already in financial distress. They lost their job or the death in the family, something happened, they're in financial distress, they're at risk of losing their home. Instead of losing their home, the mortgage servicer now has the option to extend that out to a 40-year term, something they didn't have the option to do previously. Mm-hmm. But to this point, I do think that on down the line that we will start to see the loan terms go out longer to help with this affordability crisis that we're dealing with now. In other countries in Europe, it's very common to go out to even 50 years. I've heard. So I wouldn't be surprised if we start seeing something here. The problem is that we have so much legislation in the mortgage world, and some of that legislation specifically exists around the 30-year term being a cap. And you can only offer certain type of mortgages if the term of the loan is under 30 years. So you're talking about major landmark legislation back in 2009 through 11 that would have to be completely rewritten and changed and amended to provide access to something like this. But I bet we get there eventually.
Right.
I might be retired first, but we'll get there.
All right. So, well, if you have any final questions, make sure you drop those in the chat. John, what would you say are maybe like some of your most frequently asked questions, or kind of like question of the moment of what you're seeing in the market, like right now with the clients that are coming across your desk that you're helping get into home loans?
The biggest thing is if you keep talking about interest rates going down in 6 to 12 months, why would I buy a house now? Why not just wait for interest rates to come down? And I hinted at this earlier, but I'll repeat. The reason is because if interest rates come down, you're going to be competing against, and you saw this last summer when interest rates were crazy, you're going to be competing against dozens of other buyers to secure that home. You're going to pay 5-10% more for that home. So the perfect play is to buy the house now, refinance later, because you're able to secure a better deal in the house. You have more of a balanced market, still a hot market, big time. Right. Yeah. But at least sellers will, give you the time to do an inspection and give you an appraisal contingency and finance contingency and maybe even pay a little bit of your closing cost. All those things are on the table now that when interest rates were 1.5 better, they weren't on the table.
Not at all.
You didn't get that as a buyer, period. And you paid more than the value of the house, more than the list price if it was a nice home. So buy the house now, refinance later. That's number one. Number two is about down payment funds. We talked about how little you could put down on a home, but it's important to know that the underwriter of your loan has to see where those payment funds come from. Now, we can be flexible about where they come from, but they can't just be literally stacks of Benjamins in a coffee can in your freezer, right? It has to be sourced money that we can document where it came from. And those are anti-money laundering laws. You know, it's not just because we want to pick on somebody, but the laws are very clear that, you know, we need to protect the housing industry as a whole by making sure that unscrupulous characters, terrorists and drug lords can't use the housing market to launder their funds. So that's why those rules are in place.
Yeah. All right. One final question here. Anthony asked, are 0 or 100% financing loans a good deal, or is it too good to be true?
They can be a good deal, but they're not. They're generally going to come at a cost. Somehow, some way, they're going to come at a cost. So we need to specifically identify that cost, talk about it, compare it to putting 3.5%, 5% down so that we can get the right fit.
I think another thing to think about is that as home prices continue to increase, if you're not putting anything down on a house, then also that's just increases what your overall monthly payment is going to be on that house. And sometimes just in that 100% financing option, sometimes it's just not an affordable option because of just the price of the house. Do you see that with clients that you consult with? Or does that not really play out?
Yeah, it can. It can, you know, because oftentimes it takes a little bit money down just to make the house more fit into the affordability index, right? Because what we're looking at is debt to income ratios and how much is your buying power. So it's really not your buying power, it's your borrowing power. You know, if you're qualified for a $400,000 loan, but you want a $440,000 house, okay, let's go do it. But that's going to mean a $40,000 down payment.
Right. Yeah, that makes sense.
So that's what we're going to be looking at with us for you.
Yeah, got it. All right. Well, John, thank you for joining me on the live stream today. And if you want to get in contact with John, you can reach out to me and we'll make sure that you get in connection with him. We will also put John's contact information below this video so that it's permanently there as well. You are licensed in a lot of states. So kind of tell people like the areas that you cover. So if maybe someone's not moving to Georgia, but they're moving to South Carolina and they want your help. Is that possible?
Yeah, we think of it as our absolutely. Our footprint is basically the Southeast, coming from Maryland south through Tennessee, Alabama, Mississippi, and into Florida. So anything that's at East Coast, covering into Tennessee and Mississippi, back into Florida, we got you covered.
Yeah, awesome. So sometimes we have people that reach out to us and they're considering moving to Georgia and also Tennessee, South Carolina, North Carolina, and they just don't know where they're going to end up yet. And so that's good that if you're connected with a lender that is licensed in multiple states, they can help you no matter where you land. Whereas some mortgage lenders are only licensed in the state that they practice. So that is definitely another great advantage to working with John and his team. So thank you so much for joining us tonight on the live stream. And we look forward to seeing you again and helping a lot of the viewers that are watching tonight. And of course, if you're thinking about making a move to Georgia, my contact information is below this video, and I would love the opportunity to be your realtor. Thanks, y'all. Bye.